Good morning, everybody. It is Friday, December 21st, a few days before Christmas, and the world that we know is ending. It's all over. Everything's going to hell, and you're never going to have any money ever again. All right, that's the call today, folks. Thank you very much. Well, seriously, stock market has been in correction for about a quarter. A lot longer than I thought it would last. I thought we were going to get a small little hiccup in October. Did not believe that the thin market that I talked about back in July, when I told people to be net sellers, would be quite this pronounced. So clearly has not been traded very well, and I take responsibility for that. However, there are some things that we need to jump into Realityville. The first Realityville checkup that we're going to do is the incredibly emotional nature of some investors. Not most, but some is bad for those investors, and you do not want to be sucked into the whininess that a company is losing a few trades or being down 20 or 30% on a portfolio. I'm going to tell you something. Being down 20 to 30% on a portfolio off the highs is not that big of a deal. And if you believe that it is, then you have not been around a very long time, or you have been remarkably good at what you have done, and I don't know why you're listening to me then. But a 20 to 30% correction is not that big of a deal. It is small potatoes in the grander scheme of things. And if you can buy closer to the middle and the bottoms of a correction, then when the market returns, you're going to do very well. How well? Pretty well. So these are some of the main markets: Invesco QQQ, the Spider SPY, and iShares Russell IWM. So I just like to say, look at all these drawdowns. This drawdown here, probably roughly the same as this one back in 2016. And then some of these littler ones here. Over the last 30 years, you just bought the dips, you'd be rich. Even in the S&P 500 and the IWM, you would be doing pretty darn well. And this is just price. You take price total return, it's even better, because then you get the dividends. So this should be looked at the same as this, 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 same as this. And what's going on right now, sharper, right? More elevator-like, didn't have the warning signs, didn't have the opportunities to get out. I mean, this has pretty much been a straight line down. And that is because of the thinness of the markets. And I will show one of the charts here at some point when I find it. But there's a chart in one of the articles I wrote that basically says the marginal buyer in the market is not there anymore. So in the update here, come on now. Wrote an article, 4 missing pieces of money in the market right now. Well, good grief. Did Seeking Alpha go down? What happened? Seeking Alpha disappeared on us. Is anybody else having a Seeking Alpha problem? No? All right, let's see. There you go. All right. The 4 pieces of missing money crushing the markets. We need to understand this. So the main pieces of money missing from the markets are demographic money, right? So the boomers are no longer net contributors. They're starting to get into that net withdrawal phase. And the pension funds, which are large institutions, are in the net distribution phase. Interestingly, there was a very large rotation into bonds in the last 2 or 3 months. So large, in fact, that with interest rates coming back down, it's probably very likely that some of that money finds its way back into equities now that valuations have come down and they're going to realize their gains on those falling bond yields. Big one that really irritated people this week is the $50 billion per month coming off of the Fed balance sheet that Chairman Powell basically said is just on autopilot. And I have an article that's been in editing for 2 days with Seeking Alpha that they don't seem to want to publish, but it is on the marketplace site, is on margin of safety. And I actually call for President Trump to fire Chairman Powell because, as I've said way back a long time ago, Chairman Powell does not understand the economy. He's not an economist. And his ideas about Realityville and Reality Land are not really very good. He doesn't live in Reality Land. He lives in, can I get a bigger slice of the pie land? And I want to have, some Austrian economist view of the economy because it validates me land. And it's not going to work. So in the intermediate term, a year or two out, if the Fed keeps tightening at $50 billion a month, liquidity will continually drain out of the market. And at some point, it will be a big deal. And, probably it's a big deal, but it'll become a bigger deal. Chinese investment in the United States has fallen off a cliff. And that's a big deal because they were among the marginal buyers, along with the investment banks who had to get that cheap money. But the Chinese were among the marginal buyers. So when you take away big institutions buying and you take away the investment banks buying and you take away the Chinese, that's a lot of buyers out of the market. In the fourth quarter, a record number of hedge funds closed, and they've been liquidating in a very orderly fashion, which is why the market went down in hunks, but it didn't seem crazy. And we got numbers that showed that mom and pop investors, that retail investors, the ETF people, the Vanguard people, the Fidelity people, they're not selling. So as long as that doesn't crack, there is a floor underneath the market. Where is that floor? I have shown you the chart before. 2,300 is a very firm level, but we're actually at another support level. 2480-ish is one that several technical analysts that I know pointed out. I think Ave said 2487 might be a bounce point. I think that's about what we're bouncing off of today. So, there are pieces of money missing from the market, but we have the inflows, just the constant inflows from the retirement plans and from the passive investors that does create at least some thickness, right? Some ability for the markets to do price discovery and have an absolute floor. So again, as long as the ETF and passive investors don't panic, we're probably in a range in the stock market that's the bottom is close to here, might be a couple hundred points lower. And then the top side is not only the highs that we saw earlier this year. And remember, I said that the market would make a rally to 3,000 on the S&P 500, got to about 2,900. That's pretty close. I didn't see that huge fall off coming. I thought we'd have some ruggedness in the fourth quarter. I didn't think it would be this bad. And I for sure didn't see oil falling off a cliff. So we have to take all these things into account. And instead of saying, oh, you got something wrong, say, okay, you got something wrong, now what? And I think that's important to look at because long term, not only is my track record pretty good, but again, Stock market track record is pretty good. And we can obviously extrapolate these charts all the way back to the 1800s, and you see that the stock market goes up. That's just the bottom line. The stock market goes up. There is no it's over period, right? The only time it'll ever be over is if we somehow blow the planet off, blow the planet up, or if, in the words of George Carlin, the planet gets sick of us and flicks us off. So there is no over with, right? The Great Recession, the crash here, lasted 9 months. Federal Reserve stepped in, government stepped in, off to the races. Right now, there is no Fed put. Eventually, there will be. Eventually, the Chinese will start investing in America because they have to. They have to. They cannot go it alone forever. And eventually, you're going to see the millennials start putting more money into the market than the baby boomers are taking out. And that's actually coming pretty soon. I just looked at a chart from the U.S. Census Bureau that I think CNN Money put up, and the millennials are getting very close to offsetting the baby boomers. How far away are we from that? 2, 3, 4 years? I'm not really sure, but the amount of money that millennials are making at the top end of that generation, right? Your low end of that generation is doing horrible, but your producers in that generation, the folks who got educated or learned a skill, they're making a lot of money because there is a scarcity for people who do what the smart millennials are doing and the motivated millennials are doing. And I will just basically say, if you think you're smart and you're a millennial, then all you need to do is get motivated, because there's a lot of money to be made out there, because the boomers are retiring slowly but surely. In my generation, the Xers, there ain't enough of us to replace them. So there is this hole in important positions around the country, particularly in anything, any type of engineering, any type of healthcare, anything that's a skilled trade. You know, I know housing, construction guys, contractors, and they cannot find people to help build houses. So, if you want to be a plumber, if you want to be an electrician, if you want to work in ironworking, if you want to do anything with your hands, and you're willing to get a little sweaty, you can make 6 figures. And I'm not joking about that. You can make $80, $90, $100, $110, $120,000 a year plus benefits. So there's a lot of millennials who are starting to go in that direction. And you still have about 500,000 of them, men in particular, who aren't working. And I don't know what to say about them, but the U.S. Census Bureau says that the millennials are starting to do pretty well, especially at the top end, at the skilled end, and at the educated end. So if you're 25 or 30 years old and you're like, man, I don't want to go back to college, go do a 2-year thing and become an apprentice somewhere, because you will come out of it pretty darn good, because it's just going to get better and better as the boomers retire. So going back to the market, while we don't have the Fed put here, we do have the millennial put. And I'm going to start coining that phrase, the millennial put. We're going to start getting that growth. Jeffrey South over at Raymond James, I've talked about him before. Way back here, not right there, it was about 2012. Right about here. Jeffrey South said that we started a new secular bull market. And because the boomers are in control and because of their psychology is this and this, they don't believe that this is a new secular bull market. Crestmont Research doesn't believe it either. They think we're coming back. They think we'll crash again and then finish off the bear market, the secular bear market, from here to here. Here's what I think. I think we are, in fact, in a new secular bull market, but I don't think it's as robust economically as the bull markets that we had back here and the secular economic trends we had back here, because the other economies, the other major economies, Japan, China, and Europe, are in fact getting older faster than we are. They don't have a millennial put. They don't have the millennial generation that's just going to keep pounding money into the markets, that's going to keep buying real estate, that's going to keep Every time a baby boomer says it's time to downsize, there's a millennial there waiting to buy that house, but they're waiting for the boomer to give them a deal. And the boomers are going to have to give them a deal. Again, the Xers don't have the firepower just by sheer volume size of the generation to buy all that stuff. So the millennials are actually in a great position to buy low when they want something and just earn and pound away. And the interesting thing about the millennials is they're not having their 2.3 children anymore. They're having 1.7 or 1.6 children, right? So the millennials are having a third less children than a couple generations before them. And that will smooth the demographic curve. And I wish that the article I wrote about Trump was published. I'll show you the one on margin of safety in a second. But there's some pretty interesting correlations. So what is this right here? This is a correction. You haven't had a real serious one in a couple of years. And really, you haven't had a horrible one in quite a while. But look how fast this came down. It's probably going to get a rally. And then we'll get another correction. And then you have to figure out, okay, do I believe the scenario that we're going to get a 10 or 20-year depression bear market? I don't. I believe that at some point we will have a real recession, and there will need to be structural adjustments to the economy because of the demographic situation around the world. Those structural adjustments that we have talked about are going to take the form of a very robust program to shore up the retirement system, probably helicopter money. I think almost certainly helicopter money. And then a major infrastructure plan. The Democrats and Trump will not come to an agreement. I'm 99% sure of that. The Democrats will come to that agreement with the new Democratic president in 2020. And if Trump wins, then they'll cut a deal. So I wouldn't expect an infrastructure bill until 2021. But between now and then, we're going to have volatility. And some volatility will be to the upside. Some volatility will be to the downside. So at the start of the year, I made some forecasts. Here's what I said. I also don't see much benefit of the tax cuts or future infrastructure bill in 2018. The benefits will come in 2019 as money is repatriated and some spending actually occurs. The thing is, we know that most of the found money will not be invested. It will go to pay down debts and be paid to shareholders, which is via dividends and stock buybacks. And about half the population doesn't benefit from that. So half of the population actually likes the strong dollar because it helps them buy more goods and services, and they don't have any investments anyway. I also don't think a tightening Fed and slowing China bode well for global economic growth. And these are things that are still a problem. A lot of talk about debt-driven QE loot floating around. I think we're getting closer to recognition of either inflation or that an economy just isn't really all that good organically. And the inflation that we're going to get is kind of an insidious kind. It's bottom-up inflation. Top-down inflation is when there's a lot of demand. Bottom-up inflation is when your commodities start to get more expensive because of lack of investment. Now, certain commodities are getting plenty of investment, for example, oil. The thing is that demand for oil is still going up at around 1 million barrels per day per year. The forecast is 1.3 million for next year, but let's say it comes all the way down to 1 million. To replace that 1 million barrels of oil a day in new demand and offset the roughly 30 million barrels a day that come off just because of the natural decline of oil wells and depletions, but mainly declines. There's a difference between depletion and decline. We'll talk about oil in a minute. There's going to have to be quite a bit of new production, and it's really not going to be coming from anybody anytime soon, given that ROPEC or OPEC Plus has decided on a cut, and I'm going to show you something real interesting in a minute. In any case, came all the way down here, said ultimately I see earnings disappointments by the end of the year. Up here somewhere I talked about the correction at the start of the year. We got February right? We nailed February. And I had people selling prior to October. What did I do? I abandoned my 2,500 forecast. I said that the market would be down to 2,500 near the end of the year. And I abandoned that, and I made a mistake. I started buying in too quick. So, had we not started buying in until December rather than starting at the very end of October, but really we bought quite a bit in November, and we've rotated in and out a little bit. I've told people what I was doing to mitigate things, where to raise cash. Sold QQQ a little while ago and then bought it back. We would not have taken the digger that we took. So I didn't trade this well. To that end, I have renewed my commitment to quantitative analysis because the forecast was freaking spot on. The problem, didn't trade it very well. So how do you fix the trading issue? Well, trading issues are a product of emotions and systems. And you have to control your emotions and then have a system that respects the movements of the market without being too predictive. You want to have some prediction to catch pivots, reversals, but really what you want to know is how strong is a trend. Even the best technical analysts didn't get out until about 3 weeks ago, right? The people who got out right near the top, they were actually scaling out all the way up here. And people were complaining, why are you getting out? It's going up. Why are you getting out? It's going up. And then it fell off a cliff. So the approach of scaling in and out is right. But those people who were selling from here to here, what are they doing now? They're buying again. They're just starting to buy. So where do we think the support is? We're pretty much on top of it. Let's take a look at, so QQQ's down just a shade today. Where is SPY today? Just down a shade, right? Started up, down a shade. We'll see if it accelerates up or down into the close. The fact that it keeps coming off of these closes without bottoming at the end of the day, that's positive. But as I've been saying, we broke through that 259 area on S&P, and we're going to finish below it this week. So next week, we really need the S&P 500 to have a pretty good rally. Otherwise, it'll be back-to-back weeks below support, and those lines down here around 2,300 on the S&P become very real targets. So what do you do about that? Well, when you take a look at your portfolio today, you have to say, okay, how much cash do I have? And if we go down here, this 2,300 range, you really need to be a very aggressive buyer. Here, where we are now, unless you have to fix your portfolio because you just have low quality stuff in there, there's not a lot to do. Either wait for it to come down to here or you let it bounce. And if it bounces and we get one of these rallies into, towards highs again, then you'll have to decide if you want to fade it. And I will probably be in favor of fading it a little bit as it gets towards the highs, but really as we get up to this area, that 3,100, 3,200 area on the S&P, let me put that chart over here, overlay it, is probably where the biggest resistance is. Oh, I see what I'm doing wrong. All right. So up here is where a really huge resistance happens. So you get this, you get the correction, and you get your rally up into here somewhere. And the technical analysts are all saying the same thing. So unless you have a technical analyst saying all hell's going to break loose, and we're going to come all the way down here. We're probably going to be okay. So what do you want to be buying? Well, I keep telling you, you're going to want to buy oil. You're going to want to buy technology. You're going to want to start rotating in all the smart world, everything's that are out there. When it's the hardest time to buy, maybe it is time to buy. And you want quality, right? So we want to focus on what's going on. 5G, IoT, AI, tech in general, the Permian E&P companies, right? So when I talk about oil, it's not blanket. I specifically want the low debt oil companies. I want the companies with the cheapest oil. I want the companies that could get bought out or sell assets. Those are the companies that I want. And that last part about companies that are willing to sell assets, that's important. Because as the industry continues to consolidate, you want companies like Encana that can sell off a Bakken asset. You want companies like Pioneer that have basically sold almost all their assets except their Permian assets. You want a company like Occidental that's smart enough to shut down an oil field in Qatar and focus on the Permian and environmental solutions. You really have to know the oil companies. You want companies like Centennial Resources because they are clearly an easy takeover target and have been built for that purpose. So, when you take a look at the companies that we've talked about, you have to understand why you own them. So let's talk about the plunge in oil, because everybody's angry as hell at me for this. And I get it. Oil fell a lot faster than I thought. I thought there was much stronger support. But President Trump tricked them. And if you believe that the Saudi Arabians are not going to find a way to get the price of oil back up, then you haven't been paying attention. Because a couple of years ago, when the price of oil crashed, because the Saudi Arabians wanted it to crash, they wanted to put the deep water drillers out of business. To a large extent, they have succeeded. And they wanted to put pressure on shale. But the reality is that with our tax code and with our bankruptcy code, you can't get rid of shale. Shale's here to stay until the physical constraints get to be too big and we start to see a level off and tail off in production. So production from U.S. shale is probably going to go up another 1 million barrels per day late next year, going into the end of the year. And then over the winter, it'll plateau again as it did this year. This year's plateau is flatter and longer because of the lack of pipelines in the Permian. Of course, those pipelines start to come on in the second half of next year, and that will allow those companies to really ramp it up prior to winter, rebuild inventories. We could see a very similar situation in the next couple of years as we've seen in the last couple of years, where there is incredibly high volatility in oil. So the volatility recently has been down, pretty much straight down, right? Probably going to go up, not as fast, but pretty close. Why? Because even in the Permian, in the first half of the year, they're not going to produce much more, if any more at all. It doesn't make sense for them to produce oil that they can't get out of there. So what happens is you have the service companies who had been charging more money. Well, now the E&Ps are like, we don't really have any way to get this oil out of here, and we don't want to pay your rates, so we'll just do a little here and there. And that's what's happened. In fact, U.S. oil production last month dropped by 100,000 barrels, per day. Not gigantic. It went from 10.4 to 10.3 million. But it kind of shows the point is that U.S. oil production, 11.4 to 11.3, my fault, is going to be flat probably until June, May, June, July, somewhere in there. So HFIR put out a piece that basically said what I've been saying. The Saudi Arabians have cut oil exports to the United States. In this article, and I'd encourage you to read it, right? So these guys keep pretty good track of the oil markets. And they're not much, they admit in the article that they screwed up their trade too. It happens. It happened to a lot of us. And now that the margin is no longer in the market, right? So people who were borrowing on margin, they've pretty much been squeezed out. The record high margin levels of a while back have come way back, and they're actually, I just showed the chart to somebody the other day, are really pretty much normal. There is not a lot of margin in the stock market anymore, not a lot of margin in the commodities markets anymore. They're all basically normal levels. Now, could we overshoot to the downside? Sure, but all that does is pull the slingshot back tighter, and it means it comes out screaming even faster when it comes screaming out. What's important here is that the Saudi Arabians looks like they're going to export almost zero oil to what's called Pad 3, Gulf of Mexico. That's super important. Why? Because the Port Arthur refinery that Saudi Arabia owns to supply their Shell stations is one of the places where there was a lot of inventory. They burn through about 600,000 barrels of oil a day, about half their own Saudi oil that they ship in, and about half light sweet crude. If they're not exporting any oil to themselves, right? If the Saudis aren't sending any of their own oil to the Port Arthur refining facility, the biggest in the country, that means that there's 300,000 barrels a day coming out of storage. Because that's what they need to blend with the light sweet crude to get gasoline. 300,000 barrels a day times 30 days in a month is 9 million barrels off of the inventory that everybody says is the biggest in the world. So we're at 441 million barrels of inventory. We have had draws for the last 3 weeks, which is not unusual, but it's interesting. There's no more oil inventory being built in the last 3 weeks. Why? Because there's been a shift from the countries that send us oil, particularly Canada, particularly Saudi Arabia, and that is going to start to eat into our oil inventories. By January, you'll probably see oil inventories drop 12 to 18 million barrels in the United States, and that comes from this 9 million. And then the Canadians have already turned the spigots down by 325,000 barrels a day. So my anticipation is that January inventories are about 18 million barrels less, offset by any refinery closures, which I haven't double checked. So 12 to 18 million barrels are going to come off inventory in January. What do you think the traders are going to do? The smart traders are going to start reversing their bets on oil. And then other catalysts will take hold. India has oil demand going up about 5 million barrels. Where's the number? It's in this article here. Oil price, although I don't like their subscription services, their free stuff is actually pretty good. They will give you every angle on everything, and you have to figure out what's right. But here's what I take away from this. It says oil imports to India tank 11% in November. But after the first 11 months of the year, right, their oil imports were up. I didn't highlight it. I should have highlighted it. Their imports for the year were up 5.4%. Okay. So if they're in an uptrend for oil demand, right? Oil demand rising about 5% a year. But they had a huge down month at the end of the year. What does that mean? Well, first of all, it's because the refineries were undergoing maintenance. It was normal to have less oil coming at the end of the year, but this was kind of a big number. And it had to do with the Iran sanctions on top of refineries undergoing maintenance. That means that early in the year, they're going to need a lot of oil, right? So the Saudi Arabians will have somewhere to send oil. They're not going to send it to us. What happens when the Saudis don't send us oil? I've showed this chart in the past, and I've shown you the correlations. I've got a whole article coming out on it next week. When there's not enough heavy sour, Canadian, down 325,000 barrels a day. When there's not enough Saudi medium crude, down 600,000 or 700,000 barrels a day, when all is said and done next month, then the refineries don't operate efficiently. And they have to pay more money to try to get oil from Venezuela, which doesn't have it, or Colombia, or other places that have heavy sour to blend with ours. And then the price goes up because they have to import it. So on short order, spot market starts to go up, right? So if the demand on the spot market starts to go up because Saudi Arabia isn't selling us any, then you see Brent and WTI go up. Now, the spread between WTI and Brent, so let's just keep an eye on that, is right around 10, 11 bucks, 12 bucks right now. That spread is going to stay wide until the pipelines in the Permian come on. And there's a bigger, there's a big spread between WTI and then Permian WTI. All these spreads are going to contract at the end of next year. Brent will probably be in the 80s by then, 80-ish. WTI will be 70-ish. But then there's going to be a convergence. And all these oil prices, because of more efficient infrastructure, are going to find an equilibrium. They're going to find that plateau. I've been saying peak oil plateau for 4 years now. And I think it's going to be around 80 bucks a barrel. Why? Because that's what everybody really, truly needs. Our producers can say all day long, hey, we have break evens at 40. But when you put in transportation, when you put in sunken costs, that's the big one that everybody ignores, the sunken costs. They have to pay down their debt at some point because oil is not forever. Then their break evens are higher. At about $50, $55 a barrel, these companies are doing great. But at $40, $45 a barrel of oil, they're just surviving. So, like I said, they can call it a break even, but that's a survival price. They need that price of oil over 55 to really start throwing off even more money to shareholders and pay down more debt. So when we look at oil companies, we want shareholder yield, which is the combination of buybacks, dividends, and paying down debt. Those are the companies that we have to find. Those are the companies that we have found. So as the price of oil goes back up because increasing India demand, because the waivers will probably get extended, but the numbers will come down a bit going into summer. We have to start figuring out what is really going on in the Middle East. With President Trump pulling out of Syria, pulling out of Afghanistan, I'm sure whoever is left in Iraq, we're going to be down to a basin cutter based on the way President Trump is acting. You can say good, you can say bad. Secretary Mattis just quit and says bad and pretty much ripped President Trump a new one. You choose to believe what you want to believe politically, but what I think that means for the Middle East is more instability. What does more instability in the Middle East mean? It means higher oil prices, right? So not only do we have Saudi Arabia, which feels like they got tricked with the waivers, cutting exports to the United States, not only do we have India having to have enough oil to quell their demand, we have China. This is something that just came out in Foreign Affairs. What a good article. They talk about how China played it tight to the vest for a long time, And now we're on the verge of seeing China really become even stronger because we haven't engaged them the right way for a very long time. And the approaches that the Bushes took um, probably were the closest to right. And President Obama really just backed away, and that really has, people like the man, but and I voted for him and I like him too, but he made some mistakes, and not pushing back harder on the Chinese in the South China Sea, not demanding a better IP policy. There are things that he should have done when he had that huge coalition that he did not do. And I won't say that President Trump came into a difficult situation that he couldn't handle, but he didn't handle it. What he's doing with China is worse because he didn't line everybody up against them to say, look, we want you in the world community, but you got to stop stealing from us. And at that point, you control a country's ambitions and they're cheating, right? That's a good word for it, cheating, by controlling their end markets. Well, right now, the United States has lost so much influence that we're not having a good job controlling end markets. So we have to return to a day and an age where the United States is who nations coalesce around because of our moral standing, because the promises that we make and the promises that we really keep. If the promises that we make and keep are, I want a wall on our friendly border. If the promises we make are, I'm going to charge you tariffs because I don't like some of the things you do, and then our companies are going to actually pay the tariff and then pass the cost on to the consumer, those are not the right ways. So again, I will tell folks out there that I don't think President Trump misidentifies the problems. I think that he misidentifies the solutions. And we need to be very aware of that. So China's next move into becoming a superpower, and it's already on the agenda. It's not something that I'm speculating might happen. It's already on the agenda. They're already talking about it, how to do it. China is going to start buying oil in their own currency. Not entirely, but enough to basically put an end to the petrodollar. And ending the petrodollar, which is, if you're new to the call and new to the webinar, that's the agreement that oil gets traded in dollars around the world because Saudi Arabia and the United States made a deal in 1973-74. But that was based on the idea that the United States would protect Saudi Arabia and buy a lot of their oil. We're probably getting to a day where our commitment to defending Saudi Arabia is much lower. Sure, we'll sell them weapons, but I don't see a whole lot of military going into the Middle East again. I just truly don't. I believe that we're going to see focus on containment of nuclear weapons and biological weapons. Chemical weapons are good to contain too, but the biological and the nuclear are the two that could hurt us. So between our special forces and the Air Force Base in Qatar and our naval power around the region, I think that that's the direction that things are headed. I don't think you're going to see as many boots on the ground long term. I don't necessarily disagree with pulling out of the Middle East the way that President Trump is proposing. Again, I think there's a better way to do it, and I think that General Mattis pointed that out. But we're not keeping our promise to some of our allies over there, and that's a problem, right? It makes it harder for you to do the next thing. If folks won't trust you, it makes it harder for them to do things with you, to rely on you, to be in your sphere of influence. So if we're going to remain a hegemony, Uh, if we're going to keep exercising hegemonic power, then we have to have an approach that allows us to do it. And at the end of the day, the economics are what controls things. So we need to get our allies back on board being our allies. We need to make nice with Europe. We need to make nice with Southeast Asia. We need to stop alienating our closest allies because there's bigger problems out there. And the big problems are the despots, in particular, a guy named Putin, who, by all intents that I can see, everything I can see, is one of the worst people to ever live in history. So, but a lot of Russians like him, right? So I don't like President Trump's approach, but a lot of people here like him because he identifies problems that they identify with. Again, from a pragmatic standpoint, we need to watch those things. How does that all impact the investment thesis? Well, the whole crash 2020 scenario may have actually gone out the window with this big correction, right? We might not get around to the crash 2020. It might end up being later. But if we jitterbug around because the Fed doesn't come online, because there's no cooperation, this range may be up to here, but a range could develop. Certainly don't see a huge breakout in the next 2 years. Little breakout, new highs, then a correction back down. Ultimately, at some point, there will be a crisis and we go back down to here. Actually, take that back. This area. And I don't know when that crisis comes. I wish I could tell you that. But I do think the next year, especially in the first half, we're going to see quite the rally. And we're going to see the rally in a number of places. We're going to see the rally in oil because we have the Saudi Arabians and the Canadians make an adjustment. One of the sections in the piece that I've got started oil will rise 50% in 2019. I have a section called Trudeau's Revenge. I don't know. I think it's kind of neat. Trudeau cutting export sales by 325,000 barrels a day is pretty unusual, right? So that's going to be a big deal. And the shale won't keep up until the second half of the year because of the pipeline issue. Saudi Arabia cutting their production and their exports to the U.S. And the reason that they can do it with effect is that we have a problem with our refining system and our pipelines. We need heavy sour and medium crude because that's just how things are arranged, and it can't be changed easily. But when Saudi Arabia starts taking some yuan for oil, that'll have some major impacts. First of all, the dollar will drop. How far will it drop? Probably farther than it should. The dollar is still the reserve currency of the planet because theoretically we're the most trustworthy and we have the most dynamic economy. However, there's some chinks in the armor right now. That probably didn't sound quite right. But as the petrodollar dissipates, value of the dollar will go down. Probably go down pretty far. And that will drive oil prices up for us. But for us, Saudi Arabia and China, they won't care. Saudi Arabia wants the higher prices, and China doesn't want to have to pay the higher prices, therefore let them use their own currency. See how it works? There's been a lot of people talking about the end of the petrodollar for a long time. I think it's probably right on our doorstep. How close? We'll go out on a limb and say that it happens in 2019, probably around the middle of the year. That would be my guess. So if I'm right about that, then oil doesn't just go up; it really finds a firm higher range. for at least a while until the demand for oil turns over sometime in the next decade. All right. So that's about what I got for today. I do think you should be buying into the stock market right now. A lot of money is going to come back. We talked about it last week. Hedge fund money that got pulled out because they liquidated is going to go into new investments in the first and second quarter. A lot of retirement plan money going into the market first quarter. The bond rotation from stocks to bonds, pretty much that trade is over. That money will start trickling back into stocks, and then as the stock market goes up, it'll start FOMOing in, right? It'll start going in quicker. The buybacks are going to set a new record in 2019 as companies repatriate another pile of cash in the first quarter. So if you've been taking a look at the repatriation numbers, pretty much all the money got repatriated in the first half of the year and then tailed off dramatically the second half of the year. Same thing's going to happen next year. A lot of money repatriated in the first half of the year, tail off in the second half of the year. So what can we do? We can use our quantitative tools, which I'm going to unleash on you all in the next several weeks. And one of them is Shaken. So I've subscribed to the high-end Shaken, and then I have a new tool that a day trader I know makes a ton of money using. So we're going to use his tool, but we're not going to day trade. And we're not even going to do that many swing trades. If you take a look at the quantitative systems that are out there and even the technical systems, 3 to 6 month time periods dominate the swing trading arena. Now, sometimes trades last longer, sometimes trades last shorter. But that 3 to 6 month window, which coincides with the idea of how often institutions rebalance, which is 3 or 4 times a year, which is why they're going to rebalance back from bonds to stocks, because that's what they do. They go back and forth. We can monitor those money flows. We can monitor a half dozen or so quantitative signals, and we can get these trades better. And that's really the main goal for 2019, is now that we're in a higher volatility regime, at least for the next couple of years, we have to have a better way of dealing with it. So on one hand, you have to think long term. Companies like Calix, which has got a huge growth rate, are great little companies to own. T2 Biosystems. Where do you really want to focus? You really want to focus on quality. Apple is one of the piggy banks of the world. They have so much money, it's unbelievable. And even though they're not going to sell as many iPhones, they're not going to grow iPhone sales as much as they have in the past, there's still a replacement cycle. Every 2 to 3 years, we all get a new phone. And they'll still have that. But what's important is that we enter the smart everything world. Apple has penetration into 15% of that. And it's an affluent 15%. So your early adopters, your people who will spend, a lot of them are Apple users. Alphabet, Googlebet, whatever you want to call them. They're going to start having baby Googles pretty soon. Google's going to have a family in the next decade. So you want to own the baby Googles. Leon Cooperman was talking about Google the other day. It will probably be my biggest holding by the end of next week. It's already a big holding. Amazon came down for you. They're going to split up. They're going to have AWS is going to split off at some point. In the meantime, they're going to continue to dominate, and you should not underestimate Whole Foods. I would not underestimate Whole Foods. They are penetrating markets, and their delivery and Amazon's ability to put other things in those stores are a big deal. I don't know how many of you have gone to a Kohl's department store, but when we did our Kohl's trade and did very well last year on Kohl's, is because I recognized that they had the ability to add a lot more revenue per square foot. How did I know that? Because they started to, because I go to their stores and I understood the stores and I had complaints about them that I knew that they were addressing. And then they got into bed with Amazon. So between leasing out space to Amazon, cutting deals with Adidas, with Nike, and with Pro Sports, Kohl's found ways to make more money. Now that's new money. It's found money. It's not something that's going to happen again for them. But Amazon, on the other hand, has a lot of new money that they can find. So not only can they keep refining their online offerings, but their physical offerings are going to go through the roof. Why? Because they've killed so much of the competition, and now they have a foothold through Kohl's and through Whole Foods. And then they're going to spin off AWS at some point. First Solar, long-term, debt-free solar company. Utilities love these guys. Somebody was pitching some sort of super drill the other day in the chat room from some other company. I'd be careful with super drills because ultimately, do we really want to keep tearing up the earth? But these are my 5 core holdings. PayPal. They are going to get more and more into international and bank-to-bank money transfers, and that's big money. I paid $25 to wire money the other day. You're going to be able to do bank-to-bank transfers through a central system or through middlemen like PayPal pretty soon. And they're going to use blockchain to do it. And those wire transfers, essentially they'll be wire transfers, are going to take a minute, be almost instant, right? The time it takes to send an email. So these are my 5 core stocks. These are the 5 holdings that I build everything else around, and then I trade QQQ. The oil trade is almost over. The next rally, we're going to start thinning out on the leverage, and then we'll evaluate the companies from there. I like Calix. I like T2. If you want a couple small companies, I'd be looking at those guys. I surrendered my Kinder Morgan, basically got out even, but I do own Enbridge, which I added in this fourth quarter. I just like Enbridge a little bit better than I like Kinder Morgan. They have a little bit of growth. They pay a little higher dividend. They have a little bit better balance sheet. So a little bit better dividend, a little bit better balance sheet, a little bit better growth. So comparatively speaking, Enbridge over Kinder Morgan. I don't really know that you need more than one. All right, I'm going to take a couple questions, but I am going to actually shut down the recording. So everybody have a great weekend and a Merry Christmas. Happy New Year, but we'll have a New Year's show next year. And next week, we will be introducing Dave Zanoni, the new analyst. And I am actually talking with a second analyst this afternoon. So we are going to continue to build the analyst team. Next week, I will talk about a new endeavor that I have coming up in February, not just my swing trading service, but I got invited to take part in an elite fundamental platform with a couple of technical folks. And we're going to try to make something real big happen. So good people around you usually lead to good things, right? So between the systems that I've added and really just made a recommitment to, and I do apologize for screwing up a couple trades in the fourth quarter. That sucked for you and it sucked for me, and we're going to fix it. But always remember, ultimately the market is on your side. So selling out now and panicking is probably a bad idea, given that the first half of next year is probably going to be pretty good, even though we might have another 100 or 200 points of downside short term. We'll see. I don't think that the federal shutdown is a big deal. I think that they come back to work January 2nd. And I do not think that they build the wall. I think that there's some cursory marginal improvements. Or, maybe we just, maybe we just figure out a way to pay the federal government and not have a budget deal. Who knows? We've done that before. So I'm not too worried about the government shutdown. I'm not really sure why anybody would be. It's never been a big deal before. I do think that the big story next year is going to be rising oil, falling dollar. And we will get much more into that next week as I do my futile forecast next week. It'll be published, I think, the day after Christmas. We'll see how fast they get it up. I still have something here. I wrote an article titled President Trump Should Fire the Fed Chairman. And I tell you what, if he fires the Fed Chairman this weekend, whoa, you will see quite the hiccups in the markets. But I think that ultimately, if he hires a guy like Cash Gary, you see a major rally. Oh, one other thing I meant to mention when I was showing the charts here. So this correction in here, this is the last time the Fed paused. And that's what happened. So now the Fed is basically on pause for interest rates. They said basically we're looking at 1 or 2 interest rate hikes next year. I don't think we get another interest rate hike until the fourth quarter of next year. That's what I think. So that means that we're going to get this rally. I'm not sure from where. I'm not sure how high, but there will be a rip. And you're going to want to fade it probably. And we will walk through that as it happens. We'll use our quantitative tools, our technical tools, as well as understanding the fundamental outlook and how time frames and sentiment affect when to trade, right? So have a great weekend. Enjoy your family. My son graduated from college the other day, so I'm very happy about that. Threw him a party. And he got pretty drunk last night, so good for him. He almost never drinks. But there's a lot more important things in the world than being down 20 or 30% in a portfolio, because typically it comes back. And with the way that we invest, you've seen huge gains before. We just have to work a little bit more on that margin of safety because got a little complacent, believed that the world was going to do something that it ended up not doing, even though we talked about the thing that happened. So go figure. But it'll get better. It always does. And again, rotate into quality. And you should be a net buyer now, not a net seller. Back in August, September, when I said be a net seller, I was right about that. We just bought back in too early. But if you have cash, you should be buying some of those quality names. All right, I'm going to do the chat answers offline. But have a great weekend. And again, do something fun, do something good.